Good day, everyone. Good afternoon, good morning, good evening, depending on when and where you'll be seeing this video. This is Mr. Kimbode, the King of Waves, and this is our weekly global macro with the King of Waves, where we analyze the forex market together from the professional standpoint, looking at the reality of the market from a global perspective. And today, like our usual practice, we are going to start with the first phase of our analysis. If you are hearing or seeing this video for the first time, at Potential Miners International, we trade based on a trading system called PMI Global Macro Trading System. And in this system, we have three phases of analysis. The first phase of analysis is what we call identification protocol. And that is where we do our fundamental analysis. Then the next phase, which is the second phase, is what we call the optimization protocol, where we engage in our analysis to capture the sentiment overview of the market at a global level. Then the last phase is the technical analysis, where that's what we call the initiation protocol. This is where we look at where can we position for the market so that we can trade the asset that we have identified in our fundamental phase of analysis, which is the optimization, the identification protocol, and the sentiment phase of analysis, which is the optimization protocol. The essence of this weekly analysis is to help traders, whether a beginner trader or intermediate trader or professional or advanced trader, to be able to know which of the assets are you going to be looking out for a trade for the week. And this is very important because we look at holistically what the forex market is saying at the global standpoint, and we, based on our analysis, as we have progressed from the fundamental to the sentiment and to the technical, we can now advise to say, okay, be that as it may, given the metrics that we have overviewed, this and this asset can be the asset that we should be looking out for a potential trend in the market. I want you to note, if you really want to play in the forex market and you want to play for a long time and you want to make money at a consistent level, you need to understand how to identify assets that will give you a clear trend. It's very important. You don't want to just get to the forex market and pick an asset because maybe some people are making noise about it, or you feel you like it. It's not going to really give you the profit you are looking for. I want to believe an average trader coming to the market wants to make money. So if you are to make money as a retail trader, you really need to identify an asset that will give you a clear trend, because that clear trend is what can guarantee that you can position behind the people that are moving the market, and you just ride or glide on the waves. And that's what we advise at Potential Miners International. So without further ado, let me quickly dive straight into our first phase of analysis, and that is what we call the fundamental analysis. And during our fundamental analysis, what we do usually is that we ensure that we overview the forex, I beg your pardon, the interest rate of the major currencies in the forex market. And this is very important because over the 6 years analysis or research that we conducted, we realized that the bottom line for any currency to either maintain a steady upward trend or a downward trend is the divergence of the interest rate of that currency with the currency you are pairing it with. That means that in the forex market, the narrative of capital flow largely depends on the interest rate divergence, especially when your focus is to trade along the trend. So among other indicators that we we analyze at Potential Miners International, I mean economic indicators, we consider interest rate to be central, and that means whatever the interest rate position is, or the expectation of the interest rate for the week, is what will largely determine how we are going to position for a particular currency, or when you now pair the currency with other currency, how we are going to position for a trade on a particular currency pair. So what we usually do is to look at the interest rate, and if you can see my screen right about now, you will notice that on this side of the screen you have the interest rate for all the 8 major currencies in the forex market, and we start with the Australian dollar, and this particular currency as of today, 17th of March 2026, has interest rate of 4.10%, and this is an increase of 25 basis points from 3.85 that it maintained last week into 4.10, and this increase happened yesterday. I'm still going to show you on the forex calendar, forex factory calendar, to look at events that played out, and this particular interest rate, for Australian dollar just gained, a 25 basis point increase yesterday. So that makes it still maintain the highest currency, or the currency with the highest interest rate. Next in line happens to be GBP with 3.75 and United States dollar with 3.75, followed by Canadian dollar and New Zealand dollar with 2.25 respectively. And of course, Euro maintained 2.15%, and Japanese yen maintained 0.75%, while the Swiss franc maintains 0.0%. So having overviewed the standpoint of the interest rate as of today, 17th of March 2026, what we usually do is to look at the calendar. What are we expecting for the week? Is there going to be any interest rate decision for any of the currencies? It's very important for us to align with that expectation, so that we will look forward to it. Are they going to be hiking the interest rate? Are they going to be cutting the interest rate, or they will be holding it? Now, you look at the calendar, Monday, today is Tuesday, and very early this morning, the interest rate, which is usually called cash rate for Australian dollar, was hiked from by a 25 basis point from 3.85 to 4.10, and that has already played out, and of course is part of what we have already analyzed. So the next thing we are looking for is, today is Tuesday, what are we expecting for tomorrow? Are we expecting any news event that might be related to the interest rate? Unfortunately, we have the overnight rate for the Canadian dollar. The interest rate for Canadian dollar is usually tagged as overnight rate, and that is maintaining a 2.25%. So the forecast is that there's going to be that the interest rate will not change, which means the policymakers decide, other things at constant, to hold the interest rate at 2.25. So moving down on the calendar list, we have the federal fund rate. This is the interest rate of the United States dollars, and based on what we are expecting that the interest rate will still be held at 3.75, which means the Federal Reserve is not going to hike interest rate, neither are they going to cut it. So that means that all other things as constant, by tomorrow by 7 p.m. Nigerian time, we're expecting that the interest rate for the United States dollar will still maintain 3.75 between this month and the next decision date. And that's very critical for the decision of whether you are going to trade or buy or sell the United States dollar. This is very important. Next on the line is, we are looking out for news event related to the interest rate. I want you to take note that we have other indicators that at Potential Miners International, we don't bring it up when we are analyzing the market for the general public, because we don't want fundamental analysis to become so complex. You know, when so just imagine that somebody coming to forex market is listening to us, for the first time. We don't want to, discourage you with with a lot of indicators. So our analysis or our overview of the fundamental analysis from the economic indicator standpoint majorly spotlights the interest rate. Every other indicator that can influence the interest rate can be considered, but not at the level of our fundamental analysis when we are doing this type of analysis. And that is because whether or not other economic indicator will affect the price or the movement of a currency will be dependent on the degree to which those economic indicators can affect the interest rate position. So that means that you might just take your mind off other fundamental economic indicator when you are doing the analysis that we call the identification protocol. Just focus on the interest rate. Whatever will happen to the unemployment rate, to the inflation rate, and to the gross domestic product, especially quarter and quarter, is going to transmit itself into the interest rate decision, and that is where it becomes so interesting. Are you getting it now? So largely, among other things, you want to focus on the interest rate position for a particular currency and to check whether for the week there is going to be a change in the interest rate position or not. Every other event that you see on the calendar, you are just to take note of it so that you will know when to stay off the market. Probably the movement of the market can, cut a lot of people off during the news event. So the essence of looking at other events is to ensure that you know the timing of your entry into the market, not as if you want to start to analyze all the events or all the data that is being released. You don't need to do that. Just focus on the interest rate position, then the trajectory of the interest rate position for the week, and you will be able to now compare two currencies so that you will be able to identify a particular currency pair that has the likelihood of giving you a very clear uptrend or a downtrend, as the case may be. So I just continue. We have the BOG policy, BOJ policy rate, and that is the interest rate for Japanese yen. And from what we are expecting, based on the forecast, we are expecting that the interest rate for Japanese yen will still be held at 0.75, which means Japan is not going to be hiking the interest rate by any basis point, or they are not going to be reducing it. So we are expecting that the interest rate will be held at 0.75. This week we have a lot of interest rate related decision. We still have the SMB policy rate, which is the policy rate for the Swiss franc, and we are still expecting that Swiss franc is going to maintain 0.00 interest rate. The next one is the Great British Pound GBP, the official bank rate. We are expecting that on Thursday, and that is expected to still be held at 3.75. So we have been able to overview all the. We even have the euro. You can just imagine this week alone we have the interest rate decision for almost 5 currencies. It's very important, and this particular decision is what will determine the trajectory of the movement of these currencies looking forward till the next decision rate date. And it's very important for you to pay close attention. During this news event, the market is going to experience a very unexpected volatility depending on the direction of the decision or of the interest rate. So you might need to pay close attention. So be that as it may, we want to still now look at the interest rate divergence together. So what lesson are we to pick from here? The most important thing to consider when it comes to interest rate fundamental analysis based on our own trading system is to look at the currencies with the highest interest rate. Then you look at the currencies with the lowest interest rate. Then you want to pair currencies from these two different groups. What that means is that if you pick Australian dollar with 4.01, 4.10%, you can pair Australian dollar with a currency like euro with 2.15. You can pair a current Australian dollar with a currency like Japanese yen with 0.75, and of course Swiss franc. But let me say this: anytime you have any currency with interest rate of 0.00, that particular currency, you need to treat it with a level of caution, because any interest rate with 0.00 is the safest safe haven currency globally. Let me repeat that. As much as we are saying that you should pair currencies with a very wide interest rate divergence, which means if you pick something like AUD, Australian dollar, with 4.10, you want to pair it with Swiss franc with 0.00, you need to take caution. This is because Swiss franc with 0.00 is taking the position of the safest safe haven currency for the globe as of now. So you really need to be very careful the way you pair Swiss franc, because if you are not careful, you might not be able to even explain the movement of any currency you pair with Swiss franc, especially when you are expecting the market to the particular currency to maybe buy. You might be experiencing the sell. Why? Because that currency you are pairing it with, Swiss franc, has 0.00 percentage and is maintaining the safest safe haven currency of the world. So if anything happens, investors, they will be rest assured to put capital and save it in Swiss franc with 0.0%. You just need to take note of that. However, what is important when we do the fundamental analysis is that you pair currencies with interest rate divergence that is relatively high. For instance, you can pick GBP JPY, you can pick AUD JPY, you can pick USD JPY, you can pick AUD Euro or Euro AUD, depending on the quote and the base currency. You can pick GBP, Euro GBP. You see it now, because when you compare the interest rate between these two currencies, the divergence is wide. So when you pick currencies like that, you can now optimize your choice using the sentiment analysis. Then you go to your technical to look at what you are to trade. The expectation is that currency pair with a very wide divergence should guarantee a trend, and that is why we start our analysis with the fundamental analysis, focusing on the interest rate divergence. So the next thing we want to do is to move straight into our sentiment analysis, and this is very important. And there's no how you want to win in this market and you will not consider sentiment analysis. In fact, there's no how, you will not be able to survive the dynamics of the market without having to consider the sentiment analysis. So at Potential Miners International, our sentiment analysis is rooted in analyzing 5 different indices, and I'm going to run you through them, and we are going to now conclude on what is the risk overview of the market globally as of today, 7th of March 2026. So the first one is we want to look at the S&P 500. So when we do analysis of this type, we want to go to the daily. We want to overview the structure of the index on the daily. So if you have the structure to be predominantly bullish, what that means is that there is a level of stability in the market, and investors, they are pumping money into different assets that can give them the maximum yield. But if you have on the reverse a predominantly bearish market structure on the daily structure now, especially when the cloud, these two that we use to get the tide of the market and the directional bias, when you have the tide or the cloud showing that the price is below the cloud and you have a predominantly bearish market structure, that is showing you that there is a level of fear in the market, and investors, they are gradually pulling fund away from the high yield currencies or commodities, as the case may be. So as of today, the S&P 500 index is giving us a reflection that there is fear in the market. Why? Because we have a predominantly bearish structure. If you see what we have here, something like this, you see it now. And most importantly, the price is below the cloud. The price is below the cloud, and this is related to the war going on between USA, Israel, and Iran. So it's very important for you to know why this is happening, because at any point in time that there is fear in the market globally, something must be responsible for it. So if you notice a bearish movement, you should be able to trace what is happening. Why is this movement like this? An average investor will not pull his capital, away from the market just to save it and keep it somewhere. If nothing is, if there is no reason why there is need for such an investor to do something like that, because an average investor wants to make money day in, day out, month in, month out, quarter in, quarter out, and year in, year out. So if nothing is happening that can warrant that an average investor should put their money away from the market to be on the safer side, you will notice that there will be an intention and a movement of the market to the upside, because an average investor will be pulling money to where they can make the maximum return. So we have 5 indices, and S&P 500 is one of them. The next index is the Dow Jones Industrial Average, and that is also showing us that the price is below the cloud, which means that there is a level of fear in the market. It's just like we are confirming what S&P 500 index has relay for us, and this is also related to the current war going on between Iran and the United States. So, and the next one, we have the Nasdaq Composite Index. This is still also below the cloud. And the overview of the stock market in the indices, the 3 stock market indices that we engage at Potential Miners International, is telling us that there is a level of fear in the market. Now, what this means is that plus or minus, the market is currently in a risk-off template. However, let's just look at this fear. What is the trajectory of this fear? Is this fear increasing or is reducing? Now, there is fear in the market. It's possible that this fear is now subsiding gradually. If that happens, we might need to ensure that even though we have a risk-off template in the market, the transition between risk-off and risk-on might be around the corner. And that is going to really shift what the market is doing as well. It's like somebody was very ill, and maybe something is now coming as a solution. Maybe the person took drug or treatment. As much as the temperature of the person is still not normal, but is declining. You notice that now. It's just that I'm just using that as an example. Somebody has an abnormal temperature because of the ailment in the body system, and all of a sudden there was a particular drug that was used, and you now realize that though the temperature of the person, the body temperature now is still not normal, but is not increasing, is declining gradually. You get it now. So there is a way you will respond to the market at every point in time that these things happen, so that you will know, okay, now that the market is maintaining a particular level of fear in the market, I mean a particular level of fear template, is this fear increasing or decreasing? If the fear is increasing, then it will determine where capital will be flowing into. If there is fear, but the fear is now declining, it will show that the capital will be flowing back into where it was flowing, from. I'm going to explain that when we get to each of the assets so that you understand what I'm talking about. So the next thing we do is we check the VIX, which is the fear index. I've just overviewed it. You look at the VIX now, what you will notice is that when the news of the war came, and that was around last week, we noticed that the VIX jumped to around 35, and we have said it that the benchmark or the threshold is 20. When the risk, the fix is below 20, it means that there is a stability in the market, and when it's above 20, depending on how far it is to 20, that is showing a level of fear and panic in the market. So last week, because of the war, there was a jump. Last 2 weeks into last week, the VIX or the fear gauge in the market jumped to 35, and since then it has been declining. So we have it declining from 35 down to 24, back to 28, and is now coming down. Now it's now currently at 22.74. What this means is that though the risk template of the market is risk off, as of today, 17th of March 2026, the fear in the market is gradually declining. So which means those people that are afraid formally because of the war, that put their capital out, they might see reasons now to be putting their capital into high yield again. I'm going to explain what that means when it comes to the market. I will pick asset and you will see what I'm talking about. So the next one we look at is the dollar index, and from our overview, it's obvious that dollar is gaining a level of strength at the moment. So the general overview of the market after considering the 5 indices is that we have risk of template, but with a caveat. The caveat is that the fear is gradually declining in the market, and there is a likelihood for capital to be flowing back from safe haven into high yield. I want you to take note of this. There is a risk of, as of today, 17th March 2026. But the caveat is that the level of fear is declining. You can see that played out on the VIX. It's declining gradually. So if this decline continues, you will see that the market will pump back to risk on, depending on when the news of war subside finally. So you can see that the market will transit back into risk on. So obviously we are in a risk off, but this risk off, we are within the transition window. So you really need to understand this so that when we get to the market, we'll have expectation of what can likely happen. If you have your condition met on a particular asset, you will now use what is happening on the fear template or the risk overview to project what can likely at play in the market. So having said all of this, I'm going to quickly go straight into analyzing assets, and we are going to start with gold. Like our usual practice, I will try to not waste much of time. So for gold, what are we expecting? You see, last week I said that gold will only be buying on gold because for now the directional bias on gold is a buy, and we have a risk of template as of last week, now caused by the war anyway. Now I said that we will only be buying on gold if the market close above 5,206 or something like that, 5,206, and you will notice that the market could not close above 5,206. So over last week, we were observing the market, but we could not do anything. Why? Because the market did not close above 5,206. So as of today, what are we expecting on gold? Let's go back to the risk sentiment that we have just analyzed. We said that the template of the risk overview in the market as of today, 17th of March 2026, is risk off, with a caveat that the fear is now subsiding gradually. Now, if gold will buy, two things should be happening. One or two things should be happening, or two things should be happening simultaneously. Number one, if gold will buy, dollar should be very weak. But in the case of the template that we have today, dollar is gaining strength. So we might not, on that basis, gold might not buy. The second thing that will happen if gold will buy is that we should have a risk off. Now, the risk off should be very strong so that investors will pull all their capital away from high yield, and they will be interested in saving the money into safe haven like gold, like Swiss franc, and like other assets that are safe haven like the Japanese yen also. However, what we notice is that the risk of template is not that strong, because investors, they are not pumping their money in gold, and dollar is gaining strength. We want to believe that investors decided to pump their money, even if they are going to save their money in safe haven. They decided to do that to do that on dollar, and that is very central to the movement of the capital. At the end of the day, this is going to determine whether gold is going to give us a pump to the upside or otherwise. And this is why for gold for this week, we are not expecting that gold is going to buy. Why? Because dollar is gaining strength, and the risk offset template in the market is subsiding gradually. So let me quickly analyze two other assets, because I have some visitors I need to really attend to very quickly now. So let me quickly do BTC. So what are we expecting on BTC? Sorry, sir, I will be with you in a jiffy. What are we expecting on BTC? I said last week that BTC is correcting itself at the moment, and we are expecting BTC to correct into, in fact, it is within the zone that we expect it to come into, and I want to believe that is so BTC is already within the zone that we project that it will correct into. So what we are expecting on BTC now is that BTC should pump from here to the downside into 50,000 level, something like this. So for BTC, we are expecting a sell to the downside into 50,000. This can happen between now and probably the next 2 months, depending on the volatility of the market. So that's just by the way. So on BTC, you are not to buy. If you see any buy signal on BTC, is not going to be, is not something that you should depend on. We expect BTC to sell. So let me quickly do one more asset so that we can call it a day. I really need to be off from here. I need to attend to some people. So the next asset that we are looking into is GBP JPY, and this we have already called out a trade on this, and we are expecting that this trade will deliver. All other things at constant. So GBP JPY, you notice that the interest rate for GBP was 3.75, while that of Japanese yen was 0.75. So the divergence in terms of the interest rate is very wide, and we expect this to guarantee a push up on GBP JPY, and that is why we are positioning for a buy on GBP JPY. For the signal that we projected on GBP JPY is a buy already, and the trade is already activated itself. We are hoping that all other things at constant, GBP JPY is going to buy into 213.177. All other things held constant. And this is how we analyze the market from the fundamental standpoint to the sentiment standpoint and down to the technical standpoint. If you really want to be a part of our community, you might need to join the Telegram channel. We are going to leave the link in the description below this video. You want to be a part of our trading communities where we have traders viewing the market from a professional standpoint. And if you want to be a part of that, just it's going to be free. We are not charging anybody for that. It's just like our service to the general populace. Just connect with us, on the Telegram channel. It's going to be free. Nobody is charging you for anything, so you can trade alongside with us. Until I see you in the next video, I remain Mr. Akimbode, the King of Waves. Thanks for listening. God bless you.